Howdy, Jacob here. Today we're looking at eGain Corporation in the software industry. We have 142 million market cap, 72 million enterprise value. Very small company. Small companies, I do like to look at insider ownership as one of the first things I look at. And we do see 35% held by insiders. There's going to be a lot of management, board, CEO, CFO that own the business and have voting rights, which is positive for such a small company, meaning that if you own the business, you're going to be more confident that they're going to do what's best for you as the shareholder, because they themselves are heavily invested and shareholders themselves. 142 million market cap, half enterprise value means little debt. In fact, they have more cash on hand than debt. 93 million in revenue, 76 million 9 years ago. So not looking at an immense amount of growth and very cyclical, actually. So as decline of revenue is 16% and as high of revenue is 17.5% year over year, with operating margins becoming more positive, which is awesome because they do have a fat gross margin of 70%, and they're starting to find ground with their return on invested capital as well. So very positive signs. Their income statement shows a good amount going to R&D as well. So 27 million, you're looking at over 30% of their revenue going towards research and development. That's going to take money away from today to hopefully have more in the future, make the company more efficient, all that. 70 million cash and cash equivalent, no long-term debt, no short-term debt, 69 million total liabilities. Loving this. I'm absolutely loving this balance sheet. Free cash flow has almost no CapEx, with a heavy amount of capital cash from operations, almost all their expenditures going towards share repurchases. So definitely enough for me to get to making some assumptions. For revenue growth, it's pretty cyclical, but this would be a company that it's small enough where it should be able to grow heavy, but we're just not seeing that in the past. And so for me right now, I probably don't feel more comfortable than going maybe 5%. I do think they have roughly a market average PE price to free cash flow, so I'm comfortable with that. Free cash flow margin is much higher, which I do like. And their gross margin is up quite a bit from 10 years ago, but down from the last 4 or 5 years. I think I'm going to do a pretty significant range here with share repurchases. 1% is just 1.4 million. And even offsetting stock-based compensation, that's going to be a lot of shares repurchased. Let's say maybe 2% of shares are repurchased. Right now, the company's stock price needs to fall 69% before we get the return we're looking for here. So for me at this moment, it doesn't seem obviously cheap. I think it's a great business. I loved a lot of the numbers that I was seeing. The cyclicality maybe don't like as much, but good free cash flow margin. I'm just waiting for it to be obviously cheap. As a company this small, I definitely want that extra margin of safety that doesn't come with owning an Apple or a Google that's just much more consistent. But I hope you enjoy the video and have a great rest of your day. Thank you.